Kitco News special coverage of Bitcoin 2023 is brought to you by Coin Payments, crypto payments made easy.
Welcome back to Kitco's coverage of Bitcoin 2023 in Miami. I'm Michelle Makori, and I'm now joined by a fan favorite at Kitco, Lyn Alden. Lyn, very good to have you with us.
Thanks for having me again.
Great to have you in person. And of course, Lyn, you are the founder of Lyn Alden Investment Strategy and a board director at Swan Bitcoin. So we have a lot to talk about from a macro perspective, as well as specifically about Bitcoin. But why don't we start off on the macro front and the latest comments from Fed Chair Jerome Powell. He was speaking at a policy conference today in Washington, D.C., and he made the comment that the Fed does not need to be as aggressive with its rate hikes because the banking crisis or the banking dynamic has tightened credit and sort of slowed down the economy. So the Fed is not going to have to raise interest rates as high to control inflation. His exact words were the financial stability tools helped to calm conditions in the banking sector, and developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. Again, this was part of a panel on monetary policy that he was speaking at in Washington, D.C. He also maintained that the Fed is steadfast with its fight against inflation. Why don't we start off with your interpretation of his comments there, that they won't have to do as much?
So I think there's kind of two sides of it. There's what he's saying, and then there's kind of the underlying surface of it. So I think what he's saying is correct. That basically, it's not just about rates, it's also about the rate of money creation. And if banks are liquidity constrained, if they're risk off, they're less likely to make loans, and that actually slows the economy. So I think on that front, he's correct. I think a subtext there is that because of how quickly they raised rates and how much damage they did to the banking system, basically they ended up raising rates faster than most of us thought they would in an effort to try to control inflation faster than, they basically made that their whole priority. They've created this financial instability, and now they're kind of in a situation where they have trouble raising rates as quickly as they have been, even if they wanted to, without causing more issues. And so I think that they're both trying to justify why they're going to slow down their rate hikes, and then kind of just setting expectations around the fact that they can't really do it. Because if you look at this, if you look at the 1940s, when they were trying to come off the zero bound, right? So there's all this debt in the system, they were on the zero bound, and the question is, how do you get off of that? Because it's very, very hard to do. We've had 40 years of lower highs and lower lows in terms of interest rates, and now they're trying to break that pattern. And what they showed in the 1940s is they had to be gradual with it. Because if they went too quickly, we're kind of seeing today what happens if you do it too quickly. And I think these past months have shown somewhat of a ceiling on how quickly they can do it. And so I think now they're forced to go a little slower, a little bit more measured. And then they now have to justify that narrative and see if that thesis plays out that credit contraction is enough to offset inflation.
Right. And as you said, the rate of raising rates is what led to these bank collapses. And hence now Powell is using that as support to the idea that they're going to pause. Markets are largely expecting a pause in June. What's your read on that?
So I think that they don't want to surprise markets. So I think if they were going to raise rates, they would start hinting at it ahead of time and set markets up for that potential hike. So I generally try not to predict 25 basis point moves. I think we've already gone higher than I would have expected, for example, if you asked me a year ago.
Okay.
And so it's possible they'll go a little bit higher, but I think right now they're going to be more data dependent, and they're going to try to balance between financial stability and inflation, whereas the past year they've been 100% focused on inflation. I think the last hike they did made sense because they still wanted to reserve their credibility. They wanted to have the view that they're not stopping because of the banks. But now that they got that hike in, now they have more flexibility from a public perception standpoint to pause if they want to. We'll see if they take that approach, but I think they probably will.
There has been the belief in the markets to a degree is that at some point the Fed is going to pivot, and that's why we've seen a bit of optimism in the equity markets. Hearing what Powell said about inflation, he does seem to emphasize that is still his bigger point of focus. He said failure to get inflation down would not only prolong the pain, but also increase ultimately the social costs of getting back price stability, causing even greater harm for families and businesses. Is that signaling to you that a pivot is less likely? in the second half of this year?
I think we have to separate the idea of a pause and a pivot.
Right, yeah.
I think he's trying to turn off the market's idea that he's going to have a sharp pivot or that he's going to be easy to pivot. I think he's going to basically, to the extent that he does pivot, it would only be due to pretty severe economic contraction at that point. I think the potential error here is that he's treating this like a 1970s environment. So, for example, he's referring to controlling credit as a key way of getting inflation under control. And yet, during this inflationary cycle, it was not excessive credit creation that caused the inflation. So in the 1970s, a big factor that led to that inflation, most of the money creation that was happening in the 70s was very large amounts of credit. And that's because you had the baby boomers entering their home buying years. And so you had all this excess credit creation at a time when there were real world constraints like oil and stuff like that. One thing that the 1940s and the 2020s share in common is that you had very inflationary environments, but it was not because of excessive credit creation. It was because of large monetized fiscal deficits. So I think that from the Fed's perspective, they're encountering this, they encountered this inflationary wave, which was very fiscal driven given the environment. Right. And they don't have tools to counteract a fiscal driven inflation. So they're using the tools that they have available, which are primarily about credit control, even though credit's not what caused inflation. So it's almost like they're trying to suppress credit enough that it can maybe offset what's happening in fiscal. But I think the longer term question of what's going to control inflation will be changes in fiscal spending. And I think that there's maybe too much market focus on what Powell's going to do and not enough focus on what's going to happen in the fiscal environment.
And it doesn't seem as though there's any political will to reduce fiscal spending. On the contrary, I mean, that's why we're having an impasse with the debt ceiling right now. But before we get to the debt ceiling, I want to focus a little bit more on the banking crisis because the rapid rate of interest rate increases is what triggered, to the large part, some of these collapses, given that they put their money in U.S. Treasuries, considered to be a safe asset. And then with the rates being raised as dramatically as they were, a Treasury that was purchased by a bank, say, 5 months ago, lost significantly its mark-to-market value. Would another banking collapse change the Fed's perspective here in terms of cutting rates? Or do you think that they would disregard it even if there were another regional bank to collapse?
I think it would start to get contagious. It would certainly reduce their expectations of how much they can raise rates. I mean, if this was a one-off bank crisis, if this was like one weird bank, that wouldn't really affect their overall rate tightening. We've already seen a number of banks fail, very large ones. And if you were to have another round of bank failures, especially sizable ones, I do think that would start to quickly affect not just the possibility of a pause, but that would actually open the possibility of a pivot. I think, especially if you had that combined with economic contraction data. I think that basically they can't let financial instability get completely out of control. They're able to have these kind of controlled bank failures from time to time. But if you start to get even larger bank failures or a whole nother wave of multiple medium-sized or large bank failures, that would be kind of their line in the sand.
So how confident are you that there will not be another bank failure, or do you expect there to be another shoe to drop with the regional banks?
So I think at the current time, it looks more like a profitability challenge than a liquidity challenge, in the sense that deposit rates are still creeping up, and they can only refinance their existing assets, which are their earning interest assets, so quickly. So I think the risk for banks now is that they probably are going to have to reduce share buybacks, slow or pause dividend growth, and try to build capital, right? So that's kind of the base case, is more of a profitability challenge than a liquidity challenge. But if the Fed gets aggressive again, or if there's some sort of unexpected catalyst, I don't think we're out of the woods yet for risks of further liquidity crisis. So I wouldn't say I'm confident that the banking system is settled, even though I think maybe the rate of change, the speed of some of this is behind us, but it's still a fragile equilibrium.
What about the sentiment, though? Because we had a lot of depositors pulling money out of the smaller banks, causing essentially a bank run.
Yeah.
And has that sentiment been calmed down with the FDIC saying that they're practically insuring deposits endlessly? Or do you still think that people banking at small regional banks are still monitoring developments and potentially moving their money out?
So I think ones that are under the FDIC limit, we're not seeing a lot of deposit flight. We've also seen data from some of the biggest regionals, like the super regional banks, and they're not showing signs of deposit flight, even though they're some of the ones that have pretty significant unrealized losses on their securities books. And so I think we're seeing a slowing down of this deposit flight.
Okay.
And the question is, does the Fed want to risk causing potentially another round? If they were to surprise the markets with more rate hikes, and some of these deposit rates go up more quickly, that could be a catalyst for a whole nother round of bank failures and deposit flight. So I think I think they're signaling with what Powell said that they do want to now pause or at least very cautiously move forward with tightening. And I think if they stick to that, they have at least a decent chance of causing still a bank profitability challenge, but maybe no longer a bank liquidity challenge, which is a worse challenge.
What about the idea of commercial real estate being a potential problem here? Elon Musk, Charlie Munger have highlighted it as a big anvil, according to Elon Musk, that could drop in the banking sector. What are your thoughts there?
So I do think that's a risk. I think it's a bigger risk for the shadow banking sector. That's where they have a lot of the direct real estate exposure. To the extent that it goes in the banking system, it's usually the smaller banks. If you look at some of the largest banks, commercial real estate is a small percentage of most of their loan books. And then even among that commercial real estate, like things like office real estate and other particularly troubled areas are even just a percentage of that. So, and then you have loan to value ratios that are generally not super high. And so I don't really see a ton of impact to say the largest banks, like the top 10 banks, the top 15 banks. But when you do get into smaller or medium-sized banks, they have, on average, much larger commercial real estate exposure. And then the question is, you have to go bank by bank to see what are their loan-to-value ratios. So I do think that a number of them will be challenged. A number of them will probably have to cut dividends. A number of them will face profitability challenges. But it's in a lot of the real estate funds and other things that be classified in the broader shadow banking space that are more in the direct firing line for some of this contraction in commercial real estate that's coming up.
Would you say that there is a bigger chance than not that we'll see some more regional banks fail between now and the end of the year?
End of the year? I think that's largely going to come down to Fed decisions. I think unlike the 2008 crisis, because that was a solvency crisis, that there's not much the Fed could do once it started to happen. It was basically a fiscal decision. Because this is mostly a duration problem and interest rate matching problem, the Fed at any time can determine whether or not banks keep failing or not. If they want to cut by 200 basis points, for example, they drastically reduce the chance of more bank failures, but they would risk letting inflation run hot. If they want to kind of focus 100% on controlling inflation, then they are likely to more likely to lead to bank failures. So I think with their current signaling of signaling that they're going to pause, they're starting to reduce the chance of more bank failures, but I still think we're in this kind of equilibrium zone where handful of people can basically determine whether or not we have higher inflation than expected or higher bank failures than expected. I think one of those two is probably going to surprise to the upside.
A handful of people, meaning the Federal Reserve.
Federal Reserve and to some extent Treasury officials, how they want to manage some of their Treasury general account refilling after the debt ceiling. But I think most of this comes down to the Fed and specifically Powell.
All unelected officials in the sense of the people not electing them directly.
Yeah.
An interesting point to keep in mind there. Well, other elected officials could also play a big role in this, meaning senators and the House, as they're clashing with the debt ceiling. An impasse is currently the status quo, but we have played this game before where both sides hold out. How do you see the debt ceiling playing out?
So general consensus seems to be that they're going to come down to the wire and then make a deal. I think the risk is that the market might be underestimating the probability of going days or a week over that line and having some sort of technical default for a period of time. For me, because I'm not a political strategist, I don't have a lot of insight in the probability of those outcomes, but what I am focused on is what happens after the debt ceiling. I think there's so much focus on the debt ceiling itself, there's not enough focus on what happens after the debt ceiling. And so for the past 6+ months, the story's been Fed quantitative tightening, raising rates, but something that's not been covered enough is that the Treasury has actually been offsetting a lot of the Fed's tightening. The Treasury has been emptying their cash account into the financial system. And partly that was because they had too much cash in their account to begin with compared to their target. But then starting in January, the debt ceiling actually made them lower their cash account. So when they in a situation where they were no longer able to issue new debt, one of the ways that they deal with that is they say, okay, we have an existing cash balance that we can begin drawing down. And so their target is to have about $500 billion in that account at all times. In their preferred environment, that's what they would do. But in recent months and weeks, they've drawn that down to under 100 billion, which is way below their target because they still have bills to pay, but they're not able to issue debt. And ironically, while that's happening, while that cash is draining out of this like Treasury void and back into the financial system, it's actually offsetting a lot of the QT that's been happening.
So they're nullifying each other. They're canceling each other
Exactly.
out.
They're nullifying each other. But then the question becomes, when they actually solve the debt ceiling, if the Fed wants to keep doing quantitative tightening and the Treasury is no longer emptying its cash account because it'll be practically empty, and then if they want to refill their cash account back up to their target, then it's like a double negative for liquidity because then they're actually joining the Fed in pulling liquidity out of the market. And I think that's where you could get breakage. If things surprise to the upside in terms of how bad they get, I think it would be because the Treasury does not manage that refilling process well. If they, for example, if they shorten the average duration of the treasuries that they want to issue, then they can probably handle it more smoothly because they can probably get money out of the reverse repo market and into their T-bills. If they try to refill the Treasury account quickly, or they do it too much with longer duration bonds, they're more likely to cause yet another liquidity crisis because they risk pulling that liquidity out of the banks that are already very liquidity constrained.
Given you're not advising the Treasury, and perhaps you should be, what do you think the likely scenario is then?
I think they're likely to try to refill it more slowly than they otherwise.
So they will hopefully.
But I don't have political insight to what extent Secretary Yellen is monitoring this liquidity situation. It's not something she brings up regularly. And so there actually are a number of traders that are concerned that maybe they don't fully get the liquidity implications they can have for the market if they try to refill that too quickly.
You said breakage could happen if the Fed tightens and the Treasury starts to refill, as you say, at the same time. Expand on the breakage idea.
I think the closest example would be September of last year. So for much of 2022, net liquidity was headed down because Fed was doing quantitative tightening. The Treasury was not offsetting it for most of the year. And you started to get very liquid U.S. Treasury markets. So you had, the MOVE index was super high. Auctions were kind of sloppy, Treasury auctions. And then it was even worse in the UK. You actually had the gilt market basically break and require unexpected QE temporarily by the Bank of England to stabilize it. But all the attention was on the gilt market, and there wasn't enough attention on the fact that the U.S. Treasury market was kind of only a step behind. It was very fragile in that moment. But when the Treasury started drawing down its cash balance and offsetting that, it actually reprieved a lot of it. So by breakage, I mean almost like a replication of those conditions where you would probably see a higher MOVE index. You'd probably see weaker Treasury auctions. You probably would see a stronger dollar because the dollar generally benefits from a weaker liquidity situation until you had some sort of dysfunction show up in the Treasury market or in adjacent markets or another round of bank failures. And then you'd probably have to have some sort of change either with the Treasury, how they're handling their cash refilling, or with the Fed. They might have to end quantitative tightening, or they might have to take other sort of measures to prevent that breakage.
So in that scenario, or the likelihood of these scenarios playing out, what is the best way to navigate it from a portfolio investment perspective?
So I'm primarily sticking to a diversified approach. I call it the 3-pillar portfolio, which is basically one pillar is cash equivalents, money markets, T-bills, things like that. Another pillar would be equities, just long-term compounding equities, being able to absorb that volatility. And then the third would be commodities and hard monies. It's more of the inflation component. From a more tactical standpoint, if someone's trying to trade around this, which is more challenging, I think the kind of prevention there is to somewhat be defensive until you see signs that maybe the liquidity profile is improving. So if you start to see that the Federal Reserve is going to end their quantitative tightening, or you see some sort of realization that they're starting to cause problems in the Treasury market and they reverse course, that'd probably be a buying opportunity. But I think until you see signs of liquidity kind of stabilizing after this debt ceiling, I think it's worth being defensive.
Okay. And the best way to be defensive?
probably focusing on money markets because you have cash equivalents without much counterparty risk, and your biggest counterparty is the Fed rather than the Treasury that might ironically temporarily default on you. So I think money markets are pretty attractive. And I think in general, just diversification. So having defensive equities. I've been pointing out things like energy pipelines, for example. If someone doesn't want the volatility of the producers, I think a number of the highest quality pipelines are actually pretty attractive in this environment. They've kind of washed out a lot of their leverage. Their valuations are cheaper. So I think more income-focused kind of recession-resistant businesses along with money market exposure is a good way to kind of be defensive until you see signs of a liquidity change.
How do you see Bitcoin fitting into this picture? We have seen a theme in this conference is that the banking crisis is driving more interest into Bitcoin as an alternative to traditional finance. How are you seeing that play out?
So I think on the surface, the narrative is pretty clear where basically it's, the banking system's unstable and people say, well, I can self-custody money with Bitcoin. I don't have to worry about counterparty risk. I think that's part of it, but I think probably the bigger move is basically due to markets repricing their forward expectations for how aggressively the Fed can hike rates. So we saw, for example, that, 2-year treasuries, stopped increasing. We saw that, as you pointed out, the market's pricing in cuts by the end of the year. And a lot of that changed pretty rapidly, beginning with the banking crisis. And when you have a softening of forward expectations for how hawkish the Fed can be, then it gives a bid towards kind of anti-dollar trades, scarce assets like gold and Bitcoin. And so I think the biggest move that we've seen probably in this thing is not necessarily the narrative itself, but the kind of the structural market implications of rates. So I think as the Fed shifts from, tighten money as tight as possible, control inflation as much as possible, and instead kind of balance that between financial stability, that's what's given Bitcoin and other scarce assets a chance to catch a bid. I think the challenge is that when we go back to those liquidity questions I talked about earlier, like if the Treasury tries to refill its Treasury a cash account really quickly while the Fed's still doing QT, it's probably not going to be good for Bitcoin for, say, a multi-week period, most likely. But when you do get some sort of pivot, either the Fed ends its QT program or has to launch some sort of new liquidity program, or the Treasury has to take some other action, I would be a buyer of that capitulation if you were to get one.
You said earlier that you did think that the bottom was in for Bitcoin. Is that including a scenario where you have the Treasury not play it correctly and drain too much liquidity at once in conjunction with the Fed? Is the bottom still in for Bitcoin, in your opinion, in that scenario?
So I think most likely, you can never know for sure. I think the prior cycle was instructive on this because, for example, Bitcoin formed a very big bottom in late 2018, early 2019, and then it grinded significantly higher. But then it kind of retested that bottom very briefly during the March 2020 sell-off. And so it didn't hit like lower lows, but it did kind of briefly go back and plumb those depths. And the difference was that it didn't stay there for many months. It just kind of had this like big flick down, and you had the liquidity response, and a number of weeks later, it was already back up to well above that bottom. And I think you could see a similar thing where you get kind of a brief problem that brings it down maybe lower than we expect. But I don't think it would stay in that lower band anywhere near as long as it did in this.
What is the price range of that lower band that you consider to be the bottom?
I think I wouldn't be surprised to see it touch the lower 20s again if we get that specific scenario of a liquidity crisis from trying to refill the Treasury Yellen account. There are scenarios that I think could push it to the upper teens yet again. But I think that would be it probably spend less time there than it did in this prior bottom. And instead, if they actually front run this, if the Fed ends quantitative tightening before you get the Treasury pull up, or if the Treasury does proactively kind of focus on issuing T-bills or increasing their Treasury account slower, then I think you're much less likely to retest those lows.
So a lot of to be determined factors on the horizon there, but long term, you're very much a Bitcoin maxi or Bitcoin bull, safe to say?
Yeah, I think the next 2 years or 3 years look very constructive. I think basically we have this window where the next 6 months, there's a lot of variables that I think could throw us off. I think Stanley Druckenmiller said it best. He's like, He's like, I can make the case for deflation, or I can make the case for 8% inflation. And I think he's touching on the same kind of uncertainties I'm touching on here, which is that there's very key decision points that a handful of individuals can make, and that can determine pretty big swings in what happens. So I think that basically next 6 months for Bitcoin, very unclear. I can make the case for retesting the lows, or I can make the case for, not going below 25,000. But that I think that the 2-year or the 3-year case is very, very strong. I have high conviction that basically we'll probably have another positive liquidity cycle in that environment. And right now the valuation is very attractive, compared to its longer term, say, moving averages. I also think if you look at Bitcoin holding behavior, generally one thing you see in bull markets is that long-term holders begin selling some of their Bitcoin because they're up 5x, 10x, all this new money's rushing in, and they're reducing their positions. When you have bear markets, you generally instead see long-term holders are not selling, that they're buying more. And you start to get a very large percentage of Bitcoin that haven't moved in a year or more. And right now we're very tight in that metric. Basically, we have a lot of indicators kind of either pointing that the bottom's in, or that the bottom at most is likely to be retested. And so I'm very constructive with, say, a 2 to 3 year view.
How constructive? Do you have a price forecast or a range? I know Standard Chartered, for example, Bank has Bitcoin at 100,000 by the end of 2024. We've had a number of guests on the show saying that that is a very likely, probable price point. What does Lyn Alden think?
So I might push it out to late 2025 to give myself more room, but I do think there's a good chance of seeing 6 figures in this next, call it 3-year cycle. That's not for sure. I wouldn't go levered long and assume that to be the case. I wouldn't build a business specifically that's going to happen, but if I would say my base case is I would expect to see 6 figures over, say, the next 3 years.
6 figures is in 100,000 or even potentially higher than 100,000?
I think we start with 100,000 or 120,000 and see if we get to that before making higher conviction, higher price targets from there.
By 2025?
Yes.
Let's go back to the scenarios that you mentioned. As you said, uncertain could go either way depending on decisions by certain policymakers, unelected, as we've mentioned. Is there a signal that you could see happening that would confirm it's looking to go inflationary, or it's looking to go deflationary, or the other side? Is there a particular signal there?
I think the biggest signal is that the Fed has to begin changing its hawkishness, despite the fact that they haven't met their inflation targets. So for example, if you go back to 2019 during the repo rate spike, in September of 2019, the repo market had all sorts of problems, and the Fed had to abruptly end their quantitative tightening and shift to a form of quantitative easing, and they had trouble explaining why they had to do it. And it was in large part because you had T-bills crowding out bank reserves. And if you see a similar environment where they have to kind of pivot prematurely, and yet that happens in an above target inflation environment, I think that would be a sign that they've kind of lost control of inflation, and that that would be a very strong signal to want to buy other assets, either hard assets or generally anything that would benefit from a weaker dollar at that point.
Okay, so back to reading in between the lines of what Fed Chair Jerome Powell says. So, yeah, it's a hobby for a lot of us here.
Yes.
A hobby with a serious interest. Okay, well, let's focus more on Bitcoin right now. We are, of course, at a Bitcoin conference. You mentioned a weaker dollar. Bitcoin, of course, being seen by many here as the solution to fiat debasement and devaluation, as well as a hedge against inflation, which we've covered, and as a store of value asset. Make the case for me as to what could potentially derail your thesis. What would need to happen, or what developments that are likely, or not so much likely, but on the potentially viable, that you would need to see to make you change your outlook on Bitcoin, if at all?
So I think the biggest risk, the most likely risk that would make me not change my thesis, but significantly extend my thesis, basically it would radically increase the length of time that the bullish thesis has to play out, is if you had some sort of draconian government crackdown on it. So we've seen a number of countries, Nigeria, Argentina, generally countries that are having some trouble with their currency, cut Bitcoin off from their banking system. So they're not saying it's legal to own it, but they're saying that banks can't send money to known crypto exchanges or known ways to enter Bitcoin. And so it kind of makes the off-ramps from fiat to Bitcoin narrower and harder and more friction-filled. And when those countries do it, it doesn't matter for Bitcoin. It just matters for people in those countries. They have to use more peer-to-peer methods and some more friction-filled methods. But if you were to get that in the United States, I do think that'd be a very significant price blow. I think longer term, it wouldn't change the thesis of Bitcoin, 10 years from now, being much higher than it is. But I think that could add a number of years towards the next new all-time high, or the number of years it takes to get to, say, a six-figure price target. As far as derailing the thesis permanently, I think you'd need something absolutely critical, like a completely catastrophic bug or some other problem with the consensus itself. That would be, I think, the kind of the main thesis, damaging thing from there. And even at that point, there are ways that the network can adjust. You can do basically various forks to fix the problem, but it would damage the reputation of the network if you would have something pretty catastrophic like that happen.
With the progress in quantum computing, AI, is that becoming a scenario that is gaining in probability?
I think not really. I think if anything, AI increases the importance of Bitcoin. Basically, if you imagine what machines are going to want to send to each other in terms of money, Bitcoin's kind of the most natural choice. It's something that one of the things you can do with the Lightning Network, for example, is machine-to-machine payments very effectively. But as far as quantum computing, I think it's one of those things like, nuclear fusion, quantum computing, these things are always kind of on the horizon. They're always something that is potentially out there.
Right.
But we have no idea what the time frame could be for actually a fully working, economically relevant impact from these things. If you were to get a significant quantum computer, it could damage Bitcoin's encryption. But at that point, there are either soft forks or hard forks that could be taken. So it's not an insurmountable problem, but it is kind of a moment where the shields would be down. The community would probably be split on how to deal with it, how quickly to move on it. And that would be kind of a pretty pivotal moment, I think probably comparable to the block size war. So Bitcoin went through the block size war from 2015 to 2017. The community was kind of split on what to do about the protocol. And that resolution was a positive outcome in my view. It was very constructive for the protocol. And I think if you were to have an actual quantum threat, it'd be this next pivotal moment where there are ways where it could severely damage Bitcoin unless there were ways to actions taken to make the right decision to harden the network against it.
But as you say, that is an unlikely scenario that's further out into the future. But a more immediate threat would be this idea of regulation, as we've seen in other countries. So let's touch on that, because there's a consensus amongst many that there is a lack of clarity from regulators by design, because it's withholding institutional investment and keeping things sort of, paralyzed to a degree, if you will. And there's also this idea that there is Operation Choke Point 2.0, which is a government attempt to block off the on-ramps and off-ramps to Bitcoin and to crypto at large. What are your thoughts there?
I think there are kind of two different buckets here that are happening simultaneously, and they're somewhat overlapping, and sometimes the narrative gets confused between them. So on one hand, you have a lot of crypto things that are potentially violating securities laws, that they passed the Howey test, that they are essentially securities, but they haven't registered as such. And therefore, banks are less likely to want to bank entities that are potentially engaging in securities fraud. And you have the government kind of taking pretty aggressive actions behind the scenes to try to get those companies to have more banking frictions. Mm-hmm. So that one, I think, is probably going to be with us for a while. Bitcoin itself has a clear regulatory picture from a security standpoint. The chair of the SEC, the chair of the CTFC, Commodities Futures Trading Commission, multiple different regulators have pointed out that Bitcoin's not a security. Yeah, it's a commodity. Yeah. It's very clear in that front. I think the threats to Bitcoin are not securities related, but they're more choke point related. So it's either trying to kick miners out of the country or trying to increase the frictions of getting money out of fiat currency into buying Bitcoin, similar to what we've seen in developing countries. It's kind of a funny thing where if you see a government move to restrict your access to Bitcoin, it's actually kind of an advertisement that you probably need Bitcoin,
Right.
right? Because if they weren't threatened by Bitcoin, there'd be much less reason to do that. You generally only see that in countries that are having pretty severe currency problems. But because the United States and European Union are large enough and responsible for a significant percentage of capital flows, that does pose a price risk with any sort of, let's say, 18-month or 3-year period for Bitcoin if they were to aggressively go after choke points. Basically say that, it's still legal to hold Bitcoin, but the banks can't send money to Bitcoin brokers, crypto exchanges, anything like that. It would kind of narrow the fire hose of
If that came out as official policy, and that would be significantly damaging, I would think, to Bitcoin, because the idea that choke point 2.0 is happening is it's clandestine, that it's not openly happening, it's not overtly happening. If there was some kind of stated regulation blocking off those on-ramps and off-ramps, I mean, that would be severely damaging, I would think, and not as likely to be something that's said out front or in the open.
Yeah, I think that's one of those things that would damage it for a number of years, because especially institutional capital would be much less willing or much less able to get into it. I think we'd have to ask what is happening at that time that causes them to make such a drastic action, right? So the United States is this environment that encourages, innovation. It encourages rule of law, open markets, no capital controls. And if you start to get those types of capital controls or those types of industry-specific crackdowns, you'd have to ask what's happening. Why are they so concerned about the dollar or so concerned about the rise of Bitcoin that they would take such extreme action? And I think it's kind of like Nigeria and Argentina, maybe less extreme, but in those environments, when they cut off Bitcoin, again, it's a really good sign that you probably want Bitcoin because something's not going right with the currency that would trigger such extreme action.
And that kind of action would face tremendous political backlash in the United States. Several Bitcoin lobbying groups would certainly push back against that. I don't think that is a near-term concern or a very low probability concern, but big-term picture, when you look at the position of the US dollar, there is a trend of de-dollarization. So it may not be a threat to the US now, it may not be a threat to the US for the next 10 years, but broadly speaking, we are seeing the dollar perhaps start to lose its place as the king of reserve currencies. We're seeing other countries conduct trade with their own currencies largely as a result, or partly as a result, of the dollar being weaponized following Russia's invasion of Ukraine. So we're seeing a number of countries trade amongst themselves. And we also have the BRICS countries looking to launch their own global reserve currency, a global reserve asset, potentially backed by commodities or basket of commodities, still to be determined. That meeting's happening in August in South Africa. How do you see this de-dollarization trend impacting Bitcoin in the near term and in the long term?
So I think in the near term, de-dollarization is probably overstated. Mm-hmm. It's easier to say something like, it's easier for BRICS nations to say we're going to do something than to actually agree on it, build it, make it credible, and start using it at significant volumes. So, we've seen kind of a period of de-dollarization. I think the long-term trend towards de-dollarization is clear. Basically, this kind of period is somewhat unnatural to begin with. If we have a country with 5% of the world population, but we're responsible for like 90% of international currency swaps, that's kind of a long-term unsustainable situation anyway. We've seen, for example, as India and China and the BRICS nations in general become a larger percentage of global GDP than the G7 eventually. That does result in an inherently more multipolar world, and that necessitates a multipolar currency world and a multipolar payments world so that one country can't just shut off payment systems of a country that's actually in some ways larger than itself. That wouldn't make sense. In the near term, I think some of these moves are, while they're happening, I think people might overstate the speed of them happening. So for example, de-dollarization is not really a big theme for my, say, 1 to 2 year Bitcoin outlook, but I think it does factor into, say, a 5+ year Bitcoin outlook. I think that kind of like how when you have de-dollarization, there's more interest in central banks in gold as an asset.
Record buying, yeah.
Exactly. I think so. Right now, Bitcoin is generally too small for most sovereigns. You have some smaller ones like Kingdom of Bhutan that's mining Bitcoin. they're able to kind of get into that space, but it's not large enough to be really a sovereign reserve asset. I think if you have another couple cycles of Bitcoin growth and you add to its market capitalization, to its liquidity, reduce its volatility, I think it could become a relevant sovereign reserve asset for some of these countries that want more independent, unsanctionable reserves that they can also use as unsanctionable payments. So I do think that Bitcoin is one of the solutions they can turn to, but right now it's, except for the smallest countries, it's still in many ways too small for these bigger sovereigns to fully take it seriously.
We have seen Liechtenstein, admittedly a very small country as well, saying that they're open to adding Bitcoin to their reserves and accepting Bitcoin as a form of payment now. But you're saying if we were to take a 10-year outlook, if that is indeed your time frame, do you see Bitcoin being owned by central banks in 10 years' time?
10 years' time, I do. I think it starts with the smaller ones, and it also starts with any of these small countries that not only maybe want to hold Bitcoin, but they want to signal to Bitcoin companies that they're a friendly jurisdiction. So whether it's El Salvador or Switzerland or Liechtenstein or Dubai or Singapore, whatever the case may be, these smaller countries can say, we're a neutral ground. We're conducive to working with you. If, for example, the United States makes it a pretty hostile place, then they can gather some of that business. So I think there will be probably havens. Those havens might grow in size, or kind of medium-sized havens might also want to enter that market. But I think as you get a decade in the future, I wouldn't be surprised to see larger sovereigns own Bitcoin.
And what does this mean for gold? Because you mentioned gold, and we do know that central banks have been buying record amounts of gold in this BRICS currency, potentially backed by gold, as the reports are indicating. What's your outlook then for gold?
So I'm pretty constructive on gold with, say, a 5+ year period. I think as we enter what I think is going to be another commodity cycle, I think gold will be part of that commodity cycle of higher commodity prices, generally more inflationary conditions coming in waves. So maybe not inflation in the next 6 months, but I think in the 2020s decade, we'll probably see more rounds of pretty significant inflation. And I think that, gold is likely to end this decade probably notably higher than it is now. But I do think that it'll reach a lower level than it would if Bitcoin didn't exist, right? Because now, instead of gold and to a lesser extent silver being the only kind of escape routes, I think now Bitcoin is kind of competing with that. And it kind of, if the same total market flows into these assets, it's now flowing into a greater number of assets. And so it kind of fractures. So I do think that I would expect Bitcoin to have better returns and to take some of the monetization that gold would otherwise have for itself.
You did say that you're comfortable seeing Bitcoin at 6 figures by the end of 2025. Let's use that same timeline for your gold forecast then.
I expect to see it breaking out of this current kind of triple top that it's been struggling with. I wouldn't be surprised to see, mid 2000s by that point, maybe 23, 24, 2500. There's certain, there's all sorts of potential outcomes in the war that could affect this. So this is one of those things, there's a very large range of outcomes, but I do expect to see, most likely my base case would be a breakout above this kind of 2000, 2100 ceiling that it's been struggling with, and to be higher than that.
How much higher than that?
I would hopefully like to see it in the mid 2000s. But it's, there's so many variables that go into play. I think basically I try to think directionally rather than in terms of price targets, because at any given time, there's a number of assets that can be in my portfolio.
Right.
And while it's very hard to predict what levels they're going to be at, instead I try to predict which ones are going to outperform others on a risk-adjusted basis. And I think gold scores pretty well in that regard. It's more attractive than a number of other assets I want to own. And I do think it'll be higher. I'm just very hesitant to say how high in a specific time frame.
Okay, I will let you off the hook with that one. That makes total sense.
Kitco News special coverage of Bitcoin 2023 is brought to you by Coin Payments. Crypto payments made easy.